everyone, John Henry here, slingshotfutures.com. Today we're going to be talking about a very simple type of strategy. Don't let the chart look that crazy. It's really not, but it's a strategy that's kind of designed around the newer trader. When a newer trader is coming in, they don't really have a full grasp of the markets, and maybe they've been kicked a time or two by the markets, but they haven't really gone around the block, if you will. So what this is designed to do is to keep you on the right side of things, okay? So again, this, just like any other trading setup or strategy, this isn't investment advice or anything like that. These are just general guidelines that could allow you to find potential opportunities in the markets that you could use to maybe find something of value if it fits your trade plan and your risk. So right here, we're looking at the crude oil on the 1 minute chart. The indicators at the bottom and the indicators on the screen, I'm going to cover all of those for you, so don't worry about that. But what we're looking for is a impulse leg, a move that catches a nice direction, whether it's up, down, sideways, doesn't matter, but a unidirectional movement that is pretty strong. Along with that, we're utilizing the MACD, the stochastic, the RSI, and the CCI. We have 4 different indicators at the bottom. Now, you'll probably be thinking, well, what are you talking about, John? You almost never use indicators. I don't. I'm not a big fan of indicators, but that's because I've been around for a while. I understand how the market can kick you in the face if you're not prepared for it. I get that. But for a newer trader, they might not have that experience yet. And one of the biggest problems that newer traders will run into, myself included back in the day, is staying on the right side of the market, right? Trying to go with the trend. Far too often, newer traders are trying to pick the bottom, pick the top, and they end up getting their teeth kicked in. What this is designed to do is keep you on the right direction. So what are we talking about? Well, let's look at the indicators here and kind of see what all is going on. So if we look through the indicator list, we can see quite a few things in here. Now, some of these are quality of life indicators, but the main ones are going to be the moving averages, the MACD, the CCI, the RSI, and the stochastic. So out of this list, the important ones are going to be the EMA. This is a 21 period EMA. We also have a 89 period EMA, a 200 period EMA, and a 9 period EMA. Those are the moving averages that you see on the screen. Now, along with this, we also want a VWAP, right? So the VWAP, that's the volume weighted average price. If you're not familiar with what that is, I did a full tutorial on the VWAP. Take a look at that video. But that's going to cover the major moving average or directional bias indicators. Now, along with this, we also have a stochastic. These are the indications, or the indicator settings, rather, on NinjaTrader, so your charting platform might be different. But the stochastic settings that I use are the default ones that it was designed to use. Again, if you want more information on the stochastic, or the MACD, or the RSI, or any of those, I did a video on all of those as well. But the stochastic that is generally my typical go-to is a period D3, a period K9, and a smooth of 3. That's kind of my default, if you will. Along with that, we also have the MACD. The MACD that I'm using here is a 21.55.8. Really, the settings on the MACD don't so much matter, but the reason I'm using a 21.55.8 is because those are the common moving averages that I use. A moving average convergence divergence, or the MACD. That's why I'm using those settings, because those are the moving averages that I tend to use. So 21.55, you could even use a 21.89. Regardless, these are the settings that I'm using with a slightly larger smooth of 8 to kind of bring the volatility down. If you put the smooth too far low, then it'll start looking like the RSI or the CCI, or it'll just kind of jump around. We don't want that. We want a nice smooth curve, and you'll see why in a minute. Along with that, the RSI, what a shock, 9.3. This, you'll notice a common trend here. These are a lot of the similar settings across the board because I want them to function in a very similar time span, right? I don't want one firing off 4 hours from now and the other one agreeing 20 minutes from here. I want them all to kind of line up in the same time frame. So the RSI is a period 9 with a smooth of 3, and then the CCI is a period 13. The only other thing that I add on here is a horizontal line right here at the 50 mark on the RSI. Now, the reason I like the 50 mark is because that could gauge a potential pullback. As long as the market pulls back to at least 50, preferably higher, but at least 50, you know that you may have a pullback on your hands. So what are we looking for? Well, this is where things get fun, because first of all, we need to know the trend direction. The trend direction in this case is down, and I'm looking at right here. And the reason I say down is because all of price at this point in time was not really sure. It didn't know. But when it started getting under all of the moving averages, all the VWAP, everything was pointing to the downside. Now, we can further confirm this trend by simply looking at the MACD. In this case, I have a green and red line. But the green line is below the red line. The faster line is below the slower line, showing that we are, in fact, attempting to maintain a downtrend. Now, what are we looking for? Well, what we're looking for here is a strong move. That could be a move down, that could be a move up. It doesn't really so much matter the direction. We just need a good, strong move. And a good, strong move is where a little bit of the discretion comes in. But generally speaking, if you were looking at a move and there are barely any pullbacks, right? If we look internally inside of this 1 minute drive lower, we have very few pullbacks. Almost none of the candle's swing highs are broken. If you look at a candle's high, none of them have really been broken. And every time that they were broken, it immediately failed back down. It's something that you could easily draw a trend line across the highs, and it's a very steep, angled, very tight type of channel or trend line that is not allowing the market to really get out of that, right? That is a good, strong move, and that's a general concept of trying to find what these impulse legs look like. So what we're looking for is within this impulse leg, once we start breaking out of this move down, right, we get a corrective phase back up. Now, in this case, I say corrective phase because if we look at all of our indicators, everything is pointing to a continuation to the downside. And what are we looking for? Again, the moving averages are all on the right side of one another, meaning that the 9 is below the 21 is below the 89 is below the 200, and all of those moving averages, save the 200, are below the VWAP. That's not necessarily a primary thing, but it is helpful. That way you know for sure that you're dealing with a trend when all of the moving averages are on one side of the VWAP. Again, that's not a necessity, but it helps. What we're looking for is a counter move against this strong leg down with the assumption that this strong move down will follow up with a second leg lower. Now, we can validate this as a pullback, or in this case, a retracement, rather than a reversal, based on a few things. The MACD lines are not crossing, even though the market is pulling back. We're seeing the market push back up. We're seeing it pop up against that overall trend, but the MACD, although it is faltering a little bit, is not crossing, and it's maintaining its downward pressure. Then we want to look at the RSI and the CCI. The RSI needs to get back to at least 50, and we also want to see the CCI get above 0. That is qualifying that this is a pullback when these things line up. Now, you'll notice I didn't talk about the stochastic. The stochastic is there as an added benefit in case there may be a level of divergence. Divergence can add a lot to a trade, but it doesn't necessarily always happen. So because of that, the stochastic is an optional indicator, but it can be a very useful one to have on your repertoire if you're an indicator type trader. So what we're looking for is all of those things to fall in alignment. So what do we have, right? We have a strong move to the downside. We have a counter move against that, but we look at the MACD, and if I put a box around this pullback, the MACD did not cross. Check number 1, right? That's good. If we go a little bit further, we can see, skipping the stochastic, that the RSI pulled back to a minimum of 50, right? It came back up to 50, showing that this qualifies as a pullback, and preferably above that, which it did momentarily for a little bit. And then we go further down, and we can see the CCI made it above 0. So what do we have? Well, we've got check mark, check mark, and check mark, and check mark. So everything is lining up in the same direction. The final thing that we really want to see is a halfway decent looking bear bar, right? We want something to show conviction. And we have a nice spike up and then a beautiful bear bar to the downside. That is going to trigger in sellers if we can break underneath that low of the candle, looking for continuation down. So that's the general setup. It's super easy. It's designed to be straightforward to help newer traders, and any trader really, stay on the right side of the market, but also gauge a potential risk reward. Now, why do I say that? Well, because we're entering underneath the bear bar, that means that we're forcing the market to create at least a minor swing high that we can work with. So what we can do is we can look at this and say, okay, well, if my entry point is underneath that bear bar, and my stop is going to be above the high of the swing that was made, right? So that little swing high that was made one tick above it, that's our stop location, and our entry location is one tick underneath that bear bar, which would be right there. And that means that on this specific example, you're looking at a 13-tick risk type trade, which is $130 on one contract for crude oil, which really isn't that bad. Now, where are we going to look for a target? Well, you could look for a 1-to-1 target, which would be risking 13 to make 13. You could also opt to go for something a little bit wider, like a 1.5 risk reward, which is generally my preference. Now, the reason I say that's my preference is not just because it worked this time, but that's because we're factoring in the new trader into this mentality. And a new trader generally can't discern good probability from bad, and that usually means that every trade that they're going to take is going to be roughly around 50%. It's a 50-50 bet. And if we look at the math, in the long term, if I'm looking at a 50-50 bet, risking 13 to make 13, you think, you're break even. That's not that bad. A lot of traders blow out their accounts being break even. They'd probably rather have that. But what you're not contemplating is the commission cost along with that. And to overcome that commission cost, we need to increase the amount of profit that we're willing to accept on a trade compared to our risk. So in this case, we have a short signal, which would be at 66.26, 27 or so, risking 13 ticks to make 20 ticks, and that offsets that difference. So again, if we look at the math here, we can say, well, I know that, around 50% of the time, we'll even say 40% of the time, or cut it in half, let's say 45. 45 times out of 100, we're going to make 20 ticks. That's 900. And then the remainder, right, I'll do the math just so you can see it. 100 minus 45 is 55. Would have never guessed. 55 times 13 is 715. So if we take 715 ticks on the losing side and 900 ticks on the winning side, we end up with a net gain. It's negative because I did the math backward, but a net gain of 185 ticks. You factor commission out of that, and over the course of about 100 trades, you're looking at a relatively decent reward versus risk, and this keeps you on the right side of things. Now, if you want to go a little bit further, going for a 2-to-1 wouldn't be a bad idea. Going for a 2-to-1 is honestly preferable, especially for newer traders, because again, that probability disparity that they're just not really super able to assume a probability of a specific trade. So that's the trade setup. It's super simple, it's super easy, and it's designed to get you on the right side of the market. Far too often, newer traders especially, I fall victim to this every once in a while, I think everybody does, tries to pick the bottom, tries to pick the top, and you end up getting your face kicked in because, well, you're going against the torrent, the flood, if you will, of the markets, going against that trend. So that's kind of the general idea. So hopefully that's something that maybe you'll find a little bit interesting, maybe you can add to your tool belt, and something that you might want to consider maybe keeping an eye on, something like a stochastic an RSI-CCI combination, or a MACD trend bias, or even just simply moving averages. Maybe you're a Fibonacci trader, looking for a Fibonacci pullback into a 50% while coupling that with the CCI and RSI could be a nice way to also add a little bit of emphasis. So just something to think about, but this is a great way to get you started in the right direction of the markets rather than always trying to pick the bottom and getting your face kicked in. Hopefully you find it useful. Hopefully you find it interesting. Again, as I always say, and as I always have to say, I am not a financial advisor. This is not trading advice. It's simply just a mentality that keeps you on the right side of the market more often than not, and hopefully can help you from getting your face kicked in. So that's going to do it for this one. I hope you found it useful. I hope you found it interesting. Maybe something you can add to your tool belt. Until the next time, we'll see you all in the next video. Thanks.